The pursuit of predictive certainty often leads traders down a path of increasing complexity. They accumulate dozens of technical tools. They overlay multiple moving averages and oscillators onto the price chart. This reliance on indicators is paradoxically the fatal flaw in market analysis. These tools distract the analyst from the underlying truth. They obscure the essential communication between supply and demand. The market communicates through two primary languages: price and volume. Everything else is merely a derivative of these two inputs. Before continuing, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this content to more people. For those serious about adopting this structural, disciplined approach, the foundational texts are essential reading. The cornerstone text for this entire methodology remains Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original timeless wisdom presented exactly as Wyckoff wrote it. For clarification and modern context, seek out the annotated edition by Max Davidson. This specific edition provides explanatory notes and insights without altering the original powerful lessons on judging the market by its own action. It details the necessity of strict risk management and the error of averaging down losing positions. The link to this book is in the description below. Indicators are built upon past price data. They are mathematical summaries of history. They lag the immediate actions of the professional operators. This delay means the trader receives information only after the significant movement has already begun. A moving average, by definition, smooths out the critical turning points. Momentum oscillators confirm what price has already signaled. The professional trader does not wait for a crossover or a divergence. They act on the structure of the market itself. Wyckoff's methodology demands a zero-tool approach to reading the market. The chart should be clean. The focus must remain exclusively on the interaction of the vertical bar representing price and the horizontal bar representing volume. This interaction reveals the intentions of the Composite Man. It shows where supply is being absorbed. It highlights where distribution is taking place. Relying on lagging tools forces the trader into a reactive posture. True market mastery requires a proactive understanding. It requires the ability to read the chart like a narrative. The chart tells the story of preparation, movement, and exhaustion. The price chart is not just a record of transactions. It is a battleground between informed and uninformed money. The informed money, the professional operator, leaves clear structural clues regarding their intent. These clues are visible in the Wyckoff cycle phases. They are not visible in the cross-section of two exponential averages. Ignoring the noise of secondary indicators allows the analyst to focus on the immutable laws governing market movement. The most fundamental of these laws is the principle of cause and effect. The law of cause and effect dictates that every market movement must be preceded by a period of preparation. Price never moves without reason. This preparation is the cause. The subsequent trend is the effect. Wyckoff observed that the market spends substantial time building this cause. This building phase occurs within a horizontal trading range. During this range, professional operators are either quietly absorbing supply or carefully distributing holdings. The duration and magnitude of this horizontal trading range directly determine the potential of the resulting vertical movement. A large cause must lead to a large effect. If a security spends many months in a deep accumulation range, the energy built up will fuel a significant markup phase. Conversely, a short period of distribution will likely only result in a minor markdown movement. This law provides the framework for setting logical price objectives. Professional analysis is not based on guesswork or arbitrary percentage targets. It is based on the quantifiable energy built during the consolidation phase. The analyst quantifies the cause by measuring the horizontal distance of the trading range. This is often done using specialized point and figure charting techniques. The measurement of the trading range provides a count. This count represents the minimum expected movement once the price breaks out of the range structure. For the professional operator, The accumulation phase is the effort required to absorb the floating supply. The markup phase that follows is the direct result of that effort. The market cannot sustain a large trend without a corresponding large period of preparation. The trending movement is simply the release of the pressure built up within the confining boundaries of the trading range. If the cause is insufficient, the resulting effect, the trend, will quickly stall and fail. This failure often leads the price back into the previous trading range, indicating the cause needs more time to develop. The successful application of the cause and effect law requires patience. It forces the trader to wait for the preparation phase to complete before expecting the major move to begin. This law reinforces the structural integrity of the Wyckoff methodology. It confirms that market movements are deliberate, structured events, not random walks. Understanding this principle is the first step toward decoding the actions of the professional operator, the entity Wyckoff termed the Composite Man. The Composite Man is not a literal individual. Wyckoff created this concept to personify the coordinated behavior of large institutional interests. It represents the professional operators, the powerful banking syndicates, and the wealthiest investors. This collective entity operates with immense capital and infinite patience. Its sole purpose is to profit systematically from the less informed public. The actions of the Composite Man dictate the entire structure of the market. Every major swing, every consolidation area, is the result of deliberate, meticulous planning. The professional operator must first prepare for a large move. This preparation requires time and space on the price chart. It cannot be executed instantly. The objective is twofold. First, to accumulate shares at the lowest possible prices. Second, to distribute those shares at the highest possible prices. During these preparatory phases, the Composite Man actively works to mislead the public. They use price movements and carefully timed news releases to manufacture perceived certainty. When the professional operator intends to buy, prices are often driven down sharply. This is done to create panic among smaller, weaker holders. The fear of deeper losses encourages these individuals to sell their positions. This intense downward pressure often culminates in a signature event, such as the selling climax. At this point of maximum pessimism, the Composite Man absorbs the supply. Conversely, when the Composite Man is ready to sell their massive inventory, prices are pushed to exhilarating highs. Optimism and euphoria become widespread. The public believes the price rise will continue indefinitely. This excitement and greed provide the necessary demand for the professional operator to distribute their shares quietly and efficiently. The market structure itself is a reflection of this cycle of professional buying and selling. It is the visible evidence of the Composite Man's campaign. Wyckoff's methodology teaches the trader to ignore the noise. The focus must shift away from the news headlines and toward observing what the professional operator is actively doing with price and volume. The Composite Man's intentions are etched into the structure of the trading range. They are confirmed by the relationship between the volume, which is the effort, and the price change, which is the result. The trader who adopts this perspective ceases to react emotionally to minor price fluctuations. They begin to anticipate the four main phases of the market cycle. These phases are the direct consequence of the professional operator's actions. They are the accumulation of shares, the markup phase, the distribution of shares, and the final markdown phase. Following the footprints of the Composite Man is the essential discipline. It is the key to executing trades based on structural logic rather than indicator signals. The first structural phase the professional operator engages in is the accumulation phase. This period follows a significant decline in prices. The market has experienced a substantial markdown. Selling pressure has largely exhausted itself. The Composite Man begins the quiet, methodical process of acquiring shares. This buying must happen without dramatically lifting the price out of the basement. If the professional operator buys too aggressively, the price will spike, and the necessary accumulation volume cannot be achieved efficiently. The operator, therefore, establishes a defined trading range. This range is the critical area where supply is absorbed and ownership is transferred. The shares being bought are typically coming from the hands of discouraged or panicky traders. These are the weak hands who held through the deep markdown. They are finally giving up hope. The professional operator is accumulating these shares at discount prices. This action moves ownership into the strongest possible hands. To the untrained eye, this phase appears confusing or simply boring. It is characterized by sideways price action, often with high volatility occurring only at the absolute bottom of the range. Accumulation is fundamentally a process of preparation. It is governed entirely by Richard Wyckoff's law of cause and effect. The cause is the time spent accumulating shares within the trading range. The longer this preparation phase lasts, the greater the potential effect. This effect is the subsequent upward movement, or markup. The goal of the Composite Man during accumulation is complete supply absorption. Every time the price attempts to rally within the range, the remaining available supply meets the move. This supply comes from traders who bought higher and are waiting to exit at their break-even point. The professional operator must buy up this overhead supply. They must test the market repeatedly to ensure that the pool of available shares is drying up. This testing process is crucial. It confirms that the supply side of the market is weak and incapable of forcing prices lower. It is a silent battle between persistent professional buying and exhausted retail selling. The volume profile during accumulation often shifts. Early in the range, extreme selling volume marks the selling climax. As the accumulation progresses, volume tends to diminish on downward tests. This decline indicates that fewer shares are coming to market, confirming the absorption. Only when the trading range is cleared of significant overhead supply can the following phase, the markup, successfully begin. The accumulation phase is silent, demanding patience, and it is the necessary foundation for the entire upward cycle. The upward markup phase, fueled by the professional buying of accumulation, eventually exhausts itself. Demand begins to wane significantly. The character of the market shifts entirely. This transition marks the beginning of the distribution phase. Distribution is the exact mirror image of accumulation. It is the careful, calculated transfer of shares from strong hands to weak hands. The professional operators are now the sellers. The Composite Man begins to liquidate the holdings acquired cheaply during the accumulation phase. This selling must be executed without collapsing the price immediately. They require significant sustained buying interest to absorb their massive supply. This necessary demand is usually provided by the general public. These are the late entrants, often convinced by the strong upward momentum that the price will continue to rise indefinitely. The structure of distribution reveals this critical change in supply-demand dynamics. The first major warning sign is the preliminary supply. This volume surge shows that professional selling is entering the market, even as the price is still rising. The demand then reaches a dramatic crescendo. This peak is identified as the buying climax. The price makes a dramatic, often parabolic advance on extreme volume. This marks the exhaustion of the buyers. Immediately following the climax, a sharp decline occurs. This is the automatic reaction. It establishes the lower boundary of the distribution trading range. The professional trader then watches for the secondary test. This test occurs when the price rallies back toward the peak of the buying climax area. Volume on this test rally is usually diminished compared to the climax volume. If the secondary test fails to hold high prices, it confirms the strong presence of supply overhead. The Composite Man continues to sell into any remaining strength or rally attempts. A common and highly deceptive feature of distribution is the upthrust. This is a final, decisive move above the resistance established by the buying climax. The upthrust serves a dual purpose. It traps breakout traders who buy the perceived new high. It also provides the final burst of demand required by the Composite Man. This action drives the last remaining buyers into the market. It allows the professional operator to complete their distribution at the highest possible average price. Once the entire transfer of ownership is complete, the Composite Man has successfully liquidated their long position. The market is now heavily weighted with weak hands holding expensive stock. The stage is set for the inevitable final downward movement. Once distribution is complete, the market's path of least resistance shifts dramatically. The professional operator removes support for the price. This immediately exposes the weak hands who bought near the top of the trading range. This downward trajectory is known as the markdown phase. The markdown is the inevitable effect stemming from the cause created during the distribution phase. During markdown, the price movement becomes sharp and directional. The market accelerates away from the trading range boundary. Selling pressure quickly overwhelms any remaining demand. Support levels that held during the consolidation now fail with minimal effort. The goal of this phase is to induce widespread panic. The speed of the decline often forces margin calls and emotional selling from inexperienced traders. This panic selling helps drive the price down to levels where the Composite Man can ultimately begin the process of reaccumulation at deep discounts. The markdown phase continues until selling exhaustion is reached, usually marked by a severe downward spike on very high volume. The market cycle is symmetrical, and the opposite movement is the markup phase. Markup occurs after a successful period of accumulation. The Composite Man has systematically absorbed all available supply throughout the trading range. The stock is now concentrated in strong professional hands. When demand appears, there is insufficient supply available to meet it. The path of least resistance turns decidedly upward. The price must advance quickly to find sellers willing to part with their shares at higher valuations. This is the markup phase. The markup is characterized by swift upward movement, often punctuated by minor, low-volume pullbacks. These pullbacks are necessary to shake out overly aggressive short-term traders. These brief dips confirm that supply has been fully absorbed. The price then continues its ascent with renewed momentum. Both markup and markdown represent the final, high-momentum stages of the Wyckoff cycle. These phases are where the initial preparation work, the accumulation or distribution, pays off. They define the periods of maximum profit potential for the professional trader. The professional trader recognizes that the market is always moving toward the direction of the dominant underlying force. If supply has been absorbed, the path is markup. If demand has been met and liquidated, the path is markdown. Understanding these two phases allows the trader to follow the movement rather than attempting to predict the exact turning point. It is a discipline built entirely on reading the market's preparation. The discipline of reading preparation is governed by the third foundational law of the Wyckoff method. This is the law of effort versus result. Every price movement must be analyzed in conjunction with the corresponding volume. Volume represents the effort expended by the market participants. The price change, or the lack of it, represents the result achieved by that effort. When effort and result align, the current market phase is confirmed. For example, high volume accompanying wide price spreads indicates that the movement is genuine. Great effort is yielding great result, confirming the dominance of either demand or supply. If the market is in a markup phase, high volume confirming wide price bars shows healthy demand absorbing every available share. The path upward is validated. The most valuable signal, however, is divergence. Divergence reveals the hidden actions of the professional operator, the Composite Man. This occurs when the market expends maximum effort but achieves minimum results. Consider an uptrend nearing a potential distribution area. The price pushes higher, but the volume is huge, and the price spread narrows dramatically. The effort of buying is high, but the result is poor. This suggests that professional operators are meeting the buying enthusiasm with large blocks of supply. They are absorbing the demand at the top of the range. The effort of the buyers is essentially being wasted in neutralizing the supply entering the market. This is the hallmark of supply entering the market at a critical level. It is a critical warning sign that the character of the movement is changing. Conversely, during a markdown, if selling pressure increases sharply, evidenced by massive volume, yet the price fails to make a new low, the market is signaling absorption. The Composite Man is stepping in to purchase the shares being panicked out by weaker hands. The effort of the sellers yields no downward result. This analysis of effort and result is crucial for identifying market turning points before they fully materialize. It allows the trader to see past the superficial price action and understand the underlying commitment. Another key observation involves low-volume movements. When a price achieves a significant result, a large jump or a large drop, but on very low volume the movement is often suspect. Minimal effort yields a great result only when there is little opposition. This type of action often occurs late in a trend, signaling market exhaustion. The remaining momentum lacks professional support. When the professional operators are not participating, the move is easily reversed. The professional trader uses the law of effort versus result to confirm structural points within the trading range. It is the final verification that supply has been fully absorbed in accumulation, or that demand has been fully met in distribution. This interpretation of volume brings clarity to the preparation phase. The volume signature confirms the transition from a markdown phase into the preparation phase of accumulation. This transition begins with the initial signs of professional support entering the market. The maximum point of selling exhaustion is defined by the selling climax. Prior to this event, the market often exhibits preliminary support. Preliminary support is the first significant wave of buying that slows the rate of decline. It is an early signal that professional interest is developing. However, the final capitulation requires the selling climax. The selling climax is characterized by a dramatic increase in selling pressure. This pressure is fueled by panic and emotional disposal of shares by the public. Price ranges widen significantly. The intensity of the decline reaches maximum velocity. Crucially, volume explodes to levels far exceeding anything seen during the preceding decline. This massive volume confirms that the Composite Man is actively absorbing the final waves of supply. The professional operator must accept all shares being dumped onto the market to halt the downtrend. Once this final, exhaustive selling occurs, the supply temporarily dries up. The market then experiences an immediate and sharp rebound. This rebound is the automatic reaction. The automatic reaction is often swift. It is driven by the sudden withdrawal of supply combined with aggressive short covering. Traders who sold short into the panic must buy back their positions quickly. This buying creates a powerful upward thrust. It is important to understand that the automatic reaction does not necessarily signal the return of strong, sustainable demand. It primarily confirms the temporary exhaustion of supply following the climax. The high point reached during this rally is critical. This high point establishes the initial upper boundary of the accumulation trading range. Together, the low set by the selling climax and the high set by the automatic reaction define the foundational structure. This structure is the initial trading range. This range is where the professional operator will conduct the lengthy process of absorbing remaining floating supply. All subsequent tests of supply and demand will be measured against these two initial boundaries. The selling climax marks the low of the range. The automatic reaction marks the high of the range. These two events provide the professional trader with the first clear map of the price cycle. They confirm that the market has transitioned from a markdown into a lateral preparation phase. The focus then shifts to confirming that supply has been entirely cleared out of the trading range. The defined range is only the starting point. The crucial work of the professional operator is confirming the true nature of the supply within that range. This confirmation is achieved through the secondary test. The secondary test is a measured return to the area of the previous selling climax low. It occurs after the automatic reaction establishes the upper boundary of the trading range. The primary purpose of this test is straightforward. It assesses the willingness of sellers to offer supply at depressed price levels. Wyckoff emphasized that the Composite Man does not want to begin a markup phase until the market is completely clear of weak hands. The secondary test acts as a litmus test for this clearance. If the initial selling climax truly represented the exhaustion of forced selling, then the return to that price area should generate very little renewed supply. The price action during the secondary test rarely breaches the low set by the selling climax. If the low is broken, it is usually only by a small momentary penetration. The location of the secondary test is highly important. It can occur directly at the exact price point of the selling climax low. It may also register slightly above that low. This higher low is often referred to as a successful test, showing immediate rejection of the lower prices. The most critical element to study during this retest is the volume signature. High volume on the selling climax indicates massive emotional dumping. A successful secondary test must show dramatically reduced volume. Low volume on the test signifies that the remaining supply is minimal. It proves that the prior selling climax successfully absorbed most of the available floating stock. This absorption confirms the professional presence. It tells the informed observer that the large interests are holding their positions. They are not selling into the slight market weakness. Conversely, if the secondary test approaches the low on high or increasing volume, the structure is immediately invalid. High volume during the test means that supply has not been absorbed effectively. New sellers are entering the market aggressively at those lower prices. In that scenario, the trading range is likely still dominated by distribution, or the market requires further preparation. The Composite Man must step back and wait. A successful secondary test, showing price strength and contracting volume, solidifies the lower boundary of the accumulation trading range. It is the first tangible evidence that the composite operator is succeeding in preparing the cause for the coming markup movement. This event separates the true accumulation structure from a temporary pause in a markdown trend. The professional trader must weigh the price movement against the effort required to achieve that movement. The effort is always measured by the volume signature. The secondary test is the primary tool for this measurement immediately following the initial panic. It confirms whether the selling pressure has truly exhausted itself. The secondary test confirms that the initial wave of selling has been absorbed. However, the professional operator rarely commits to the markup phase without a final decisive action. This final maneuver is designed to clear out any remaining weak hands. It serves as the ultimate test of supply or demand exhaustion. These traps are known as the spring and the upthrust. The spring occurs within an accumulation trading range. It is a temporary break below the established support line. This move is calculated to deceive the public. Many traders place their protective stop orders just below a known support level. The spring dives down, grabs that liquidity, and triggers panic selling from those fearing a new markdown phase. The Composite Man uses this brief panic to finalize the absorption of supply at favorable low prices. A true spring must recover swiftly. The price must jump back quickly above the support level it just violated. Volume is critical here. If the penetration below support occurs on low volume, it signals a lack of serious selling pressure. The market is showing true exhaustion. The sharp rally back into the range confirms the trap was successful and the Composite Man is now committed. The inverse structure is the upthrust. This occurs during a distribution phase. The upthrust is a temporary penetration above the established resistance line of the trading range. The most powerful version is the upthrust after distribution. This action convinces the public that the market is breaking out to new highs. It attracts new buyers who fear missing the next phase of the rally. The Composite Man sells aggressively into this manufactured excitement. The trap is sprung when the price fails to sustain the breakout. It must immediately reverse and fall back into the trading range. The failure of the upthrust is a powerful indication of weakness. It shows that the professionals were using the public's enthusiasm to offload their remaining inventory. The spring and the upthrust are the market's final shakeouts. They are aggressive, short-term moves that violate the boundaries of the trading range. They are designed to create maximum psychological distress for unprepared traders. Recognizing these traps allows the astute trader to avoid being shaken out of a profitable position, or worse, entering the market right before a major reversal. They mark the conclusion of the absorption or distribution process. They signal that the market is ready to commence the sustained markup or markdown movement. The signal that the market is ready to commence the sustained markup or markdown movement requires immediate execution. Professional execution demands patience followed by decisive action. The entry point must be structured logically, based entirely on the geometry of the trading range. Wyckoff emphasized that the highest probability trades occur at the edges of these defined ranges. The structural events previously identified, the spring in accumulation or the upthrust in distribution, provide the necessary confirmation. Following a successful spring, the market must demonstrate its newfound strength. It must show a sign of strength by decisively moving higher. Entry is not taken during the chaos of the spring itself. It is taken once the market proves that the shakeout was successful. The ideal entry is often found on the pullback or the secondary test of the immediately preceding low. This test must occur on significantly reduced volume. Low volume on the test confirms that supply has been fully absorbed by the Composite Man. This is the low-risk entry point for the sustained markup. Alternatively, the entry may be triggered when the price clears the resistance line that defined the top of the accumulation range. This breakthrough confirms the change of character. It shows that demand has overwhelmed the remaining available supply. The inverse logic applies entirely to the distribution phase. Following the trapping action of an upthrust, the market must fail to hold its high ground. It must execute a decisive break below the support line of the trading range. This break is known as the sign of weakness. The astute trader waits for this demonstration of underlying weakness. The entry is executed either on the initial break or, more conservatively, on the subsequent test of the broken support. This broken support now acts as resistance. When the price returns to test this level, volume must be low. This low-volume retest confirms that demand has dried up and the Composite Man is prepared for the markdown. Executing a trade based on these structural tests dramatically increases the probability of success. It ensures the entry is placed immediately before the sustained move is expected to begin. The market provides clear blueprints for entry. The key is recognizing the change in character that confirms the structural event. This change happens when the market breaks the established boundary, then successfully tests the boundary from the opposite side. In accumulation, the entry is placed near the bottom of the range, confirmed by the spring and the subsequent sign of strength. In distribution, the entry is placed near the top of the range, confirmed by the upthrust and the subsequent sign of weakness. These are the points of maximum leverage and minimum risk. These are the points of maximum leverage and minimum risk. This minimum risk must be structurally defended. Risk management under the Wyckoff method is logical, not arbitrary. The placement of the stop-loss order is determined entirely by the trading range structure. Stops are not based on a 2% or 3% rule. They are placed at the exact point where the market proves the underlying schematic analysis wrong. If the analysis is invalidated, the trade must be exited immediately. The structural stop is the professional trader's insurance policy. Consider the accumulation phase. The structural low is established by the selling climax, the automatic reaction, and the subsequent secondary test. When the trade is entered following a successful spring, the stop is placed beneath the absolute low of that spring. If the price returns below the spring low, it suggests that absorption failed. It confirms that supply is still dominant, and the Composite Man is not yet ready to initiate the markup. The hypothesis of accumulation is broken. Holding the position past this point is speculation, not trading. In the distribution phase, the logic is reversed. The high point of the trading range is typically set by the upthrust or the upthrust after distribution. The entry is placed after the sign of weakness confirms the downward bias. The stop-loss order is placed just above the highest peak established in the range. If the price moves above the upthrust after distribution, it signals that professional selling has failed. Demand remains stronger than anticipated, and the market may be transitioning into a further accumulation phase. The expected markdown is canceled. The stop placement in both schematics defines the risk unit. Since the entry is executed near the structural boundary, the distance to the stop is minimal. This small risk is balanced against a potentially massive reward, targeting the next significant area of support or resistance. Wyckoff emphasized that favorable risk-to-reward ratios are mandatory for success. By entering at the edge of the range and placing the stop just outside the invalidation point, the ratio is often 3-to-1 or 4-to-1. The trading plan requires absolute adherence to this structural stop. Once the position is taken, the stop order must be executed simultaneously. It cannot be moved further away from the entry, regardless of market volatility. This discipline ensures that losses are small, predictable, and manageable. It frees the trader from emotional decision-making when the market moves against the position. The market structure, not emotion, dictates the risk taken. This adherence to structural risk defines the professional operator. Trading based purely on price action and volume requires intense mental discipline. It demands that the trader view market speculation as a serious business. The Wyckoff method strips away the noise and complexity of modern indicators. It forces the trader to focus solely on the fundamental interplay of supply and demand. The zero-tool approach simplifies the visual field dramatically. The chart ceases to be a predictive tool and becomes instead a map of institutional intent. Price bars and volume bars are the only required inputs for analysis. Richard Wyckoff taught that everything needed for a sound decision is contained within those two elements. Lagging indicators are eliminated entirely from the process. The focus shifts completely to anticipation, not reaction. The professional trader anticipates the movement out of the trading range based on the confirmed cause built within the accumulation or distribution structure. Mastery of the cycle is achieved only through relentless practice. The trader must learn to see the phases, accumulation, markup, distribution, and markdown, as they unfold in real time. This requires immense patience during the confusing transition periods. It demands courage when entering a position based on structural confirmation, such as a successful secondary test or a confirmed spring. The ultimate lesson of the Wyckoff methodology is control. Control over the size of the position, control over risk exposure, control over the emotional response to volatility. The goal is to align one's actions perfectly with the intentions of the Composite Man. When the professional operator is buying, the Wyckoff student buys. When the professional operator is distributing, the Wyckoff student sells or liquidates. This disciplined alignment minimizes guesswork and maximizes the chances of participating in the major moves. The methodology is cyclical and timeless. It works because it is rooted in human nature and the laws of economics. The professional trader understands that the market is always moving between periods of preparation and periods of movement. For those serious about adopting this structural, disciplined approach, the foundational texts are essential reading. The cornerstone text for this entire methodology remains Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original, timeless wisdom presented exactly as Wyckoff wrote it. For clarification and modern context, seek out the annotated edition by Max Davidson. This specific edition provides explanatory notes and insights without altering the original powerful lessons on judging the market by its own action. It details the necessity of strict risk management and the error of averaging down losing positions. The link to this book is in the description below. This discipline is the final step toward market mastery. It is the path to truly understanding the language of price and volume.